Will the US experience stagflation in 2025? As we look ahead to 2025, a pressing question is on many minds. Will the United States face stagflation? This economic term describes a situation where inflation is high, growth slows down, and unemployment rises. Recent developments suggest that this scenario could be a real possibility. Just yesterday, the Federal Reserve announced that interest rates will remain steady at 4.25 to 4.5%. This cautious approach signals uncertainty about the economic outlook. The Fed has warned that tariffs imposed by the previous administration could increase the risk of stagflation. These tariffs may lead to higher inflation and unemployment amid slowing growth. Federal Reserve Chair Jerome Powell has pointed out that tariffs have negatively impacted consumer and business sentiment. If these tariffs stay in place, the risk of stagflation could increase. The Fed's current strategy is to take a wait-and-see approach, reflecting their acknowledgement of these risks. In the first quarter of 2025, the United States economy contracted by 0.3%. This decline was driven by weak consumer and government spending, along with surges in imports ahead of the tariffs. This combination of factors aligns with the classic signs of stagflation. Unemployment has also risen, moving from 3.4% in 2023 to 4.2% in 2025. Despite previous rate hikes, inflation progress has stalled. Job losses and persistent inflation are symptoms often associated with stagflation. Economists like Torsten Slok from Apollo Global Management have placed the probability of a recession at 90% in 2025. Recessions often accompany stagflation scenarios, raising concerns about the economy's future. However, some analysts argue that fears about tariffs and economic damage may be overstated. They point out that many Chinese goods facing tariffs have exemptions, and businesses are finding alternative sourcing options. The services sector continues to expand, and wages are reportedly outpacing inflation, which could help avert a full stagflation crisis. The Federal Reserve's cautious stance and lack of immediate rate cuts suggest they believe inflation can be managed without triggering a severe recession or prolonged stagflation. Stagflation poses a challenge to capitalism as it disrupts the normal economic mechanisms where inflation and unemployment typically move in opposite directions. Tariffs can distort market efficiencies, increasing costs for businesses and consumers without boosting domestic production enough to maintain growth or employment. In summary, the United States faces a tangible risk of stagflation in 2025 due to tariff-related disruptions, persistent inflation, and slowing economic growth. However, some sectors remain resilient, and there is ongoing debate about the severity and duration of this potential stagflation.